Hi, Gabriel Josiah here. In this session, we are diving into a crucial metric in asset management called the non-current asset turnover. Imagine assessing how effectively a company's core assets are being utilized to generate revenue. This analysis isn't just academic, it's professional and it's a powerful tool in your hands to understand and optimize performance in any business setting. Whether you're a student or a chartered accountant in training or applying these concepts at work, mastering this ratio will bring you one step closer to real-world financial acumen. Let's break it down as I share my screen, which is our usual custom to do. So let's look at this ratio graphically with a practical example on how to calculate the non-current asset turnover ratio. Okay, I believe you can see my screen right now, and I'll share it. Let's look briefly into this powerful metric. It measures the rate at which non-current assets of the company generates sales revenue. So non-current asset in the sense that you have your long-term assets, which you traditionally call the fixed assets, which includes property, plant, and equipment, tangible assets, and intangible that have a longer lifespan, huge investment embedded or buried in them. It measures the effectiveness at which the company is putting its non-current assets into use to generate revenue. So the non-current asset turnover, we're trying to see how you've used that component of asset to generate revenue. How many times has your revenue been turned over? That's what it simply means. So it's calculated as follows. The non-current asset turnover means your sales or your revenue divided by your current asset to see how many times you've turned over your sales from the current assets you employed in the business. It measures how efficiently a company uses its non-current assets, like I've described, the property, plant, and equipment, investments, tangible and intangible asset to generate sales. Provides insight into how well the company's long-term investments. Non-current assets are long-term investments. They don't just span 1 year, they span 5 to 10, at times to 20 years, depending on their useful life. This long-term investment is tested here to see how many times it contributes to revenue generation. So this is the formula graphically on the screen, which is our net sales or revenue divided by the average non-current assets, which is our beginning non-current asset as valued and our ending current assets in that financial year divided by 2 to get the average. So we have the net sales like we described as the revenue from sales activities, while the average non-current asset, like I just described, is the beginning non-current asset plus ending non-current asset divided by 2. Okay, so let's use this formula to graphically explain and calculate the ratios. Still with our example, Sharubutu Nigerian PLC. Let's pick our revenue figure. Our revenue figure is the same, which is 1.2 billion naira. So let's have our average non-current asset. So in our statement of financial position, we have the non-current asset and we have the current asset. So here we are only using the non-current asset. So we have the beginning, 1st January 2020, and we have the ending, 31st December 2020. So we pick the 2 components of the non-current assets If you have your calculator, just follow me closely. So we have the beginning and the end. So our total non-current assets for this the beginning. We duplicate this as the end. Very simple. Okay, so while having that, this is 550 million naira. Let's have our average non-current asset. Let me abbreviate that, which is our total beginning and ending divided by 2. Very simple. Our total, which is about 1 billion naira, and we divide it by 2 to have the average, which is 500 million naira. So what is our non-current asset turnover? I abbreviated the non-current asset to save time. All right. So our non-current asset turnover based on our formula states that we have our sales revenue divided by our average non-current assets. See it as 2 times. See it as 2 times. So our sales revenue covered or is above our non-current asset for the year 2020 twice, which is good. What could be better? Okay, so let's see what this means. Let's describe what this means. It means this shows how much revenue a company generates for each unit of currency invested in its long-term assets. Long-term asset means it's non-current assets. This is very important. Take note of it. It shows how much revenue a company generates from each unit of currency invested in its long-term assets. A higher ratio means the company is utilizing its long-term investments effectively to generate sales, while a lower ratio may suggest inefficiencies in asset usage. And the implication is that a high non-current asset turnover indicates the company is efficiently using its long-term asset to support revenue generation year in, year out. A low one implies underutilization of these non-current assets, meaning the company might not be getting enough return on its long-term investments. The cost of a high non-current asset turnover includes efficient use of fixed assets, well-managed operations, high production and sales volume relative to the value of those long-term assets. For example, production from those property, plant and equipment, and the resultant effect of the sales volume it generates from such assets or produced goods or services. The effect is that a high non-current asset turnover improves profitability, shows better returns on investment, and efficient capital allocation. Conversely, a lower one shows underutilization, outdated assets, low sales volume, overinvestment in non-current assets without proportional revenue generation. So where you have a low non-current asset turnover, the cost could be overinvestment in non-current assets and underutilization of the same, because it doesn't culminate in proportionate revenue generation. Also, the effects of a lower profit, the effects of a low non-current asset is lower profitability, increased carrying cost of the assets, potential need for asset revaluation or optimization. So these are the effects of a low non-current asset turnover ratio. The lower profitability impacts the company entirely. Carrying cost of the assets increases, and there's potential need for asset revaluation or optimization. In conclusion, the non-current asset turnover ratio is a vital indicator of how well a company's long-term investments in these assets contributes to its sales performance. While a high ratio reflects efficient use of non-current assets, leading to better profitability and operational efficiency, a lower one signals the need for the company to improve asset utilization to enhance financial performance. This is very critical. Now, having looked at that, we must understand that the practical understanding of non-current asset turnover is key. From exams to boardrooms, this ratio will help you evaluate the backbone, a company's revenue generation, be it managing the company's assets or analyzing financial performance. This metric or ratio is key. Thank you very much for watching. Don't forget to like, subscribe, hit the notification bell for more finance insights geared for your exams, studies, professional journey, and real-world finance applications. Keep pushing towards that professional edge, and see you in the next video. Until then, bye for now.